Welcome to the 12th episode of Dividend Investing Insights, your one stop for all things dividend investing. Join us as we explore tips and techniques to maximize your dividend and increase your wealth one dividend at a time. In the episode today, we will continue to look at growing our dividend portfolio. We have been creating a dividend portfolio for the past 3 weeks. We'll continue to build on that and see, what is a good share to buy for the week that's gone by or the week that's coming up. Anyway, before we go into that, let's look at the performance of the markets for the week. S&P 500 went up by 77 points to end at 5,815 points or 1.35%. Nasdaq too went up by 1.45%, and here locally in Australia, ASX went up by 0.79% or 8 or to end at 8,214.5 points. Well, as I have said in the past, markets go up and down all the time, but you as a dividend investor should focus on stocks that have the ability to pay the dividend in the current year and continue to increase dividends in the years to come. Now, going back to our topic of the creation of the dividend portfolio, let's do a quick recap of what we have done until now. A couple of weeks ago, rather 3 weeks ago, we had bought KDP 50 stocks at 37.46 for an investment of 18.73, which had an ex-dividend date of 27 September 2024. Um, and we had bought it on time. This was paying out 23 cents per share with a pay date of 11th October. So we have received this dividend now, and we will look at it at the end as to how this impacts our portfolio value. We also bought JP Morgan Chase a couple of weeks ago for $210.5 for a total investment of $2,105. This had an ex-dividend date of 4th October 2024 and was paying out $1.25 per share with a pay date of 31st of October. Last week, we had bought AT&T. We had bought 100 shares for 21.91 with an ex-dividend date of 10th October, paying out 27.75 cents and a pay date of 1st of November. Anyway, so this has been our investments in the past. Let's look at what is it that we can buy for the week to come. So again, as a practice that we have been following, we will look at the dividend calendar scan. We'll do a scan of the dividend calendar and see as to what stock could be a good buy for us. So let's go right into it. Now, on the scan of dividend calendar, I come across Colgate Palmolive. Now, Colgate Palmolive viewers is a dividend king, and in one of the earlier episodes, we had talked about dividend aristocrats. And just to give you a quick reminder, dividend aristocrats are those shares that have been paying their dividend for the last 25 years, not only paying their dividend but increasing a dividend. Colgate Palmolive goes into a bigger category. It's actually a dividend king, and dividend kings are those shares that have been paying dividend for not 25 years but 50 years. And Colgate Palmolive not only has been paying dividend for the past 50 years but has been increasing its dividend. Well, this seems to be a very good buy, but before we jump into it, let's look at whether this is a good buy for us. Looking at our objectives, is it a good buy? But just a quick reminder, as of this recording, the market price is $100. It has an ex-dividend date of 18th October and will be paying out 50 cents per share. Again, like always, we will use our dividend investing checklist to go through Colgate Palmolive and see whether it meets or passes all the criteria that our checklist have. A quick reminder, this is our checklist. Do we understand the company's business? What is the dividend for the current year? And what is the dividend yield for the current year? What is the average dividend yield? What is the payout ratio, price to earnings ratio, price to book ratio? Does the company have a year-on-year revenue growth, profit growth? And does it have a positive cash flow? So we look at all these parameters, and rather than going individually, let's put them all together. So do we understand the company's business? Yes, absolutely. Probably all the viewers that are watching have used Colgate Palmolive or have used Colgate Palmolive at some time or the other. It has a relatively low dividend yield of 2%, which is okay, but if we, since it has been increasing the dividend in the past years, the dividend yield is likely to go up. So it's not a cause of concern, but that's okay. What's the last dividend yield for the last average dividend for the past 5 years? 1.8. And as it has been increasing, this is a reflection of that. So 1.8 has gone up to 1.98, which is a very good sign. Payout ratio, again, reasonably good, 56.56%. Just to remind the viewers, this should be between 30 and 70%. So 56.56% is quite good. What's not working well here for Colgate Palmolive, as you can see, is the PE ratio is quite high, 29.18. In fact, I'm not putting the number of the price to book ratio. Price to book ratio is also quite high. What I also saw, that while the revenue is growing, but the debt is high. It does have a year on year growth and does have positive cash flow. So if you look at this, there are three things that are not working well for Colgate Palmolive, which is the PE ratio, PB ratio, and the year-on-year revenue growth. While the revenue growth is there, but I could see a high debt value, which is a cause of concern, which then results us that we will not buy this share. So while it seemed to be very good on the surface, but a high PE ratio means that there's a lot of premium that is associated to it. It's much higher than what the right price should be. So we will not buy this. We look at other shares. This is not worth our investment at this point of time, looking at our objectives. So let's look at the scan again. Let's look at the calendar scan again, and I come across Procter and Gamble. Procter and Gamble is again a big, large corporation, pharmaceutical company. Again, part of the dividend kings. It's also been increasing its dividend for the past 50 years. And as of this recording, has a market price of $171. Is has having an ex-dividend date of 18th of October, which is next week, and paying out $1 per share. Again, let's put it through our dividend investing checklist. Putting the checklist again, you are familiar with it, and let's put the numbers in directly and see whether it is doing well or not. Do we understand the company's business? Yes, absolutely. Pharmaceutical manufacturers company manufactures medicines and everything to do with pharmaceuticals. Dividend yield $3.96 for the current year. As an overall dividend yield, 2.35. Again, comparatively low, but not a cause of concern. Dividend yield for the past 5 years, $3.636. Again, being a dividend king, the average dividend for the past 5 years is bound to be less than the current year. Payout ratio, reasonably good, 63.6. P ratio, again, 28.42, quite high. From past episodes, you would remember that anything, a P ratio of between 1 to 20 is recommended. PP ratio, again, quite high, 8.12. Again, as a standard, should be between 1 and 3. What is alarming is that it has negative quarter-on-quarter revenue degrowth. The revenue is not growing; it is going down, and also the profit is going down. The profit is it's not able to sustain the profit. It's not able to sustain the revenue. It could be due to market situation, the inflation that we're seeing in the market, or whatever factors. But as an investor, this is not a good sign for us. But while all of this is there, that company does have positive cash flow. So looking at these parameters that you see, high P ratio, high PB ratio, negative Q on Q revenue, and negative profit, I think this is a no buy again. So, a second share which we felt could be a good addition to our portfolio, but is no, we are not going to buy it because of high premium. Ideally, the price, if it was lower, it would have been a good buy for us, which would have meant that the dividend yield would have been higher, P ratio would have been higher, PB ratio would have been lower, and we could have investigated more as to why the Q on Q revenue and Q on Q profit is falling. But at the current levels, this is a no buy. So a further scan did indicate that there were no other attractive companies. Either a company had a negative cash flow or something. So there's no share that I could see in the upcoming week, which could be a good addition to our portfolio. So anyway, um, and it's not necessary that we have to buy. So let's look at our portfolio, how our portfolio is performing for this week, as of stand. So remember, KDP we had bought 50. As of this recording, has a price of 36.28 to give a investment value of 1814. JP Morgan in the last 1 week has increased, so it has almost increased by $10 or $11, which is reflective in the current price. AT&T is more or less flat from last week. which gives us a total investment of 6173.9. However, this is not our current dividend portfolio value. Remember that we have got dividend of KDP in this week, which is of 23 cents per share, giving us $11.5 in our account, making it a total investment of 6185. Viewers would remember that last week it was 612261. So while it has increased, not a significant increase, however, if you look at a weekly basis, it is quite good. But we will look at a longer period. Once we have overall our investments and once we reach that value of $10,000, then we'll start to track it on a weekly basis as to how it is moving and what regulations or what um, tweaks we need to make to our portfolio to make it a very profitable portfolio. But anyway, so it's increased in the recent past, which is a good sign. uh, well, that's towards the end of the video. But just quickly remembering what are the upcoming dividends for us. So JP Morgan will be paying out on 31st of October and AT&T will be paying out on 1st of November. And that's the end of the episode. And like always, putting up the dividend checklist again. Please use it for all your investments. Use it and apply it on all shares, any company across the world, to see whether the company is going to be a good buy or not. Well, that's the end of the episode. Thank you and look forward to another episode with you soon.